December 2nd, 2001. For 6 years in a row, Fortune magazine named Enron the most innovative company in America. There was just one problem. The innovation was the fraud itself. But to understand how the 7th largest company in America simply evaporated, we need to go back. July 16th, 1985. Two names, Houston Natural Gas and InterNorth, merged to form a new company in Houston, Texas. At the center stood Kenneth Lay, the polished executive with a knack for politics and Wall Street charm. Lay wasted no time moving the headquarters to Houston and renaming the company Enron. He promised a bold future, not just pipelines, but a new kind of energy giant built for a world about to be deregulated. Lay's secret weapon arrived in 1990. Jeff Skilling, a former McKinsey consultant, believed the future belonged to traders, not builders. Skilling pushed a radical idea, ditched the old model of owning power plants and pipelines. Instead, Enron would become a market maker, trading energy like stocks, living light on assets, and heavy on deals. The company called it asset light. Investors called it genius. Wall Street couldn't get enough. Fortune magazine named Enron America's most innovative company 6 years running, from 1996 to 2001. By August 2000, Enron's stock hit $90, giving the company a market value near $70 billion. Enron had become the 7th largest company in the United States. Now here's the detail almost nobody mentions. The smarter Enron looked, the bigger the pressure to keep the illusion alive. Now here's the detail almost nobody mentions. In January 1992, the SEC gave Enron permission to use mark-to-market accounting, a move that rewrote the rules. Under this method, Enron could sign a long-term energy contract, guess how much it might make over 10 years, and record that entire imagined profit as revenue right away. Imagine selling a house you haven't built yet, deciding what it could fetch in a decade, and writing that full profit into your bank account today. That's how Enron turned future optimism into present-day success. The numbers looked spectacular. But on paper, profit was always running ahead of reality. Year after year, Enron's reported earnings soared, even when the underlying business was far less stable than it appeared. The smarter the company looked, the more dangerous the illusion became. In 1998, a new architect of deception took the stage. Andrew Fastow, Enron's chief financial officer, didn't just shuffle numbers, he built entire shadow systems. LJM, the Raptors. These weren't ordinary partnerships. They were special-purpose entities designed to keep Enron's worst risks and debts out of sight. Court records showed Fastow ran both sides of these deals, buying troubled Enron assets at inflated prices, then borrowing millions to fund the purchases. The debt never touched Enron's official books. On paper, the company looked stronger than ever. In reality, those liabilities were piling up in the dark. Now here's the detail almost nobody mentions. The structures were supposed to be independent, but Enron was still deeply entangled. Investigators later found that when the assets lost value, Enron propped up the partnerships with its own stock. Earnings stayed high, but it was all smoke and mirrors. The LJM partnerships and Raptors acted like invisible pulleys, making the magic trick work, while the real risk never left the building. March 2001. Fortune magazine hits newsstands with a question that cuts through the hype. Is Enron overpriced? Bethany McLean's article doesn't accuse, but it pokes holes. How does Enron actually make its money? Why are the numbers so hard to follow? For the first time, the company's confidence looks fragile. Wall Street analysts start whispering about gaps in the story. Some reporters dig deeper, chasing footnotes that don't add up. The market still believes, but the spell is breaking. August brings a shock. Jeff Skilling, the architect of Enron's trading empire, resigns as CEO. He cites personal reasons. Behind closed doors, the board scrambles. Kenneth Lay steps back in. The public gets reassurances. Inside, panic sets in. That same month, a memo lands on Lay's desk. Sharon Watkins, a vice president, puts it in writing. Enron could implode in a wave of accounting scandals. The phrase is stark. It's a warning shot from inside the walls. But this is where the story becomes almost unbelievable. The world outside still sees a powerhouse. Yet inside, the cracks are turning into chasms. The illusion is close to breaking, and almost nobody on the outside can see how fast the ground is giving way. October 16, 2001. Enron reported a quarterly loss of $618 million. The numbers, once engineered to dazzle, now landed like a confession. 6 days later, the SEC opened a formal investigation into Enron's accounting. Wall Street's faith collapsed in real time. The stock, once worth $90, plunged below $1. Creditors circled. The Dynegy merger died. On December 2, 2001, Enron filed for bankruptcy in the Southern District of New York. It was the largest corporate bankruptcy in American history. The final bill for shareholders, about $74 billion gone. The illusion was over. The reckoning had begun. 20,000 people lost their jobs overnight. For many years of retirement savings disappeared, along with the Enron stock they had been told to trust. Paychecks stopped. Health insurance vanished. Some employees learned their nest eggs were gone only after the bankruptcy hit the news. Arthur Anderson, Enron's auditor, shredded boxes of Enron documents as investigators closed in. Soon after, the 89-year-old accounting giant collapsed, taking thousands more jobs with it. Prosecutors said Jeff Skilling received a 24-year sentence, but served about 12 years. Andrew Fastow, the architect of the hidden partnerships, got 6 years after cooperating. Kenneth Lay died in July 2006 before he could be sentenced. And if you think this was just one bad company, look closer. Enron vanished, but the illusion survives. Every market bubble, every too-good-to-be-true balance sheet. Someone's still betting you won't look closer. The smartest guys? They're always in the next room.